CMHC Insurance, new rules for 2020. If you're new to our channel, my name is Felix Chan, realtor and mortgage broker with the LiveInnerCity real estate team, where we bring you honest real estate and mortgage advice. And if you don't want to miss out on valuable tips from us, then make sure you hit the subscribe button and the notification bell so you know when we come out with these videos. Now, what is CMHC and why is this important? Well, CMHC stands for the Canada Mortgage and Housing Corporation. And it's important because anyone who's putting less than 20% down must purchase mortgage default insurance. Otherwise, banks would want people to put 20% down or more. Now, CMHC is coming out with some new rules effective July 1st, and they're making changes to their insured mortgages. It's now going to be more difficult for people to qualify for a mortgage if they're putting less than 20% down. Now, there are four main changes that you need to be aware of. And the first two has to do with your debt service ratio. There's some technical information in this area. And for those who want to nerd out, this is for you. So the first one is the GDS ratio, or the gross debt service ratio. The GDS is the percentage of a borrower's income needed to pay for all of the required housing costs. So things like your mortgage payment, property taxes, heat, and 50% of your condo fees. It is currently 39, but come July 1st, it's going to be brought down to 35%. The second is your total debt service ratio, or TDS. It is right now at 44%, but it's going to be brought down to 42%. Now, this is the percentage of a borrower's income that's needed to pay for all of your home costs, as well as any other liabilities the borrower has, such as credit cards or lines of credits. The third is the borrower's credit score must be 680 from what it is today at 600. And lastly, borrowed down payments are no longer accepted. So things like credit cards or HELOCs or any borrowed money that's secured by an asset. Why is CMHC implementing these new rules? Well, they came out with a report that was pretty grim on the real estate market. And they're expecting that up to 20% of those who had deferred their mortgage payments because of COVID-19 aren't going to be able to make their mortgage payments. They're also expecting that house prices can drop from 9 to 18% and could go up to 25% in oil-rich provinces like Alberta. Now, what do these changes mean for buyers? Well, someone who's earning $70,000 with 5% down can qualify for a mortgage today for $343,000. However, when the new rules are implemented on July 1st, they can now qualify for a mortgage of $303,000, which is just under a 12% difference. So their purchasing power has basically decreased by 12%. Now, they can still have a gifted down payment from immediate family members. Now, here's a tip for you guys. In Canada, there are 3 mortgage default insurers. CMHC is only one of them, although they are the biggest one. There's still Genworth and Canada Guaranty. So when you're looking to get a mortgage and you don't want to lose your purchasing power, ask your lender if they are working with Genworth or Canada Guaranty. Chances are they are. And so you can request for your mortgage default insurer, if you're putting less than 20% down, to be insured with Canada Guaranty or Genworth Canada. They have confirmed that they are not making any changes to their rules. So this can work in your benefit. Now, we don't know how long that's going to last. That could change at any time. So it's best to be able to buy a property now sooner than later. Hopefully you found this information valuable and that this gave you some clarity surrounding CMHC's new rules. If you have any questions about this and or anything mortgage or real estate related, throw it in the comments below and we will definitely reply to you. If you want more valuable tips, check out our videos in the playlist here or down in the description below, and we'll be looking forward to seeing you in our next video.